Okay, there we go.
Sort of.
Welcome. You're listening to The Best of Investing on Talk 910, the show where we present valuable information about real estate, the financial markets, and other economic business of the day. I'm your host, Edward Brown, and I'm proud to have as my co-host Mark Hoff of Pacific Private Money, California's fastest growing mortgage investment firm, and Rob Spinoza of RPM Mortgage. Our phone number is 888-912-1190. Use that number to answer the trivia questions for 3 vacations given away during each commercial break. That's right, we're giving away 9 vacations during this show. Now, the vacations are not sponsored by the radio station, but by Lighthouse Resort and Marina, located 1 hour northeast of San Francisco. The vacations are free. Their only request, $75 cleaning fee to cover housekeeping expenses. Their website is lighthouseresortmarina.com. You can reach them at 916-777-5511. Today's trivia theme is U.S. historical tragedies in the 1970s. Can you get any more specific than that?
Okay.
Our website is bestofinvesting.com. Check us out on Facebook and YouTube by typing Best of Investing Radio Show, and we're also on TV. Comcast Channel 26 and AT&T Channel 99, Saturdays at noon, Sundays at 6 p.m. Guys, let's just get right into it. Rob, you've got some interesting articles to cover.
Well, thanks for putting me on the spot, number one.
You're very welcome. Anytime.
Hello, everyone.
Yeah, so I have been going through some of the real estate statistics that we are unable to avoid in my line of work. I work for RPM Mortgage. A lot of people talking about, are we in a bubble? A lot of people having difficulty getting into contract on homes they like. They go out there, they get beat up, they compete against 10 different offers. So the natural response is to say, are we in a bubble? Am I overpaying for this house? Is this market getting beyond me? And I think here in the Bay Area, and that's defined, generally speaking, as a 9-county area here around San Francisco. Golden Gate is the epicenter, that we're not. And the reasons I believe that's true is because we have virtually 100% employment. That's unique for practically anywhere in the United States. When you take out those who have quit looking or who are unemployable, they're probably also not buying a house. But then we also have rents increasing, and we have median home prices increasing. So both of those things are telling me that we've got housing that is very much in demand.
So, Rob, you brought in some articles or statistics for just Marin County
Right.
of all places, which in some parts of the Bay Area is not representative, but it actually, I think, is representative to what's happening in both San Francisco and the Silicon Valley, basically the peninsula counties.
Yeah.
And what were some of those statistics we were talking about before the show?
Well, Marin's a little unique, like you said, because it's only, for September, for example, just under 200 sales, and there's a lot of what they, call, there's a lot of money in Marin County that is inherited. There are a lot of people that owned and sold businesses, and they joke about it, people who wrote best-selling novels, things like that. But in Marin, you have the median home price at $1.1 million. So right away, you're talking about a fairly exclusive environment.
And San Francisco, though, is not too far off.
Yeah, San Francisco is not too far off, but higher volume of sales to kind of dilute that a little bit. But you have an environment where still, even considering that, you've got 20% all cash offers, and you've got a very good combined loan to value. Marin and across the Bay Area, I look at that like this: if you buy X amount of real estate, whatever that dollar value is, and you finance X percentage of that, what's your combined loan to value across the Bay Area? I think it's running like 60% right now, which is incredible.
Yeah. Well, when you're talking, Robert, about are we in a real estate bubble, there's a couple of things that are at play here. And so, earlier this summer, I made the mistake of started reading this blog post from one of this real estate organizations that kept predicting that, we're in a bubble and real estate is, we predict real estate is going to fall 10 to 15% by year's end or at least in early 2015. And as the years progressed, I'm starting to believe that less and less that it's going to happen. And here's the reason why. The reason that they believe, those who say that real estate is going to pull back, are saying, look, the increases in wages, the increases in income is not keeping pace with the increases in real estate prices. And that's technically how you determine, when you're hitting the ceiling of real estate price increases. Now, however, that model doesn't quite work with Marin, San Francisco, and Silicon Valley, because here's what's happening is the people who can't afford the home prices in those counties are just getting pushed out by the people who can. And there is more and more wealth being created every day. There is an incredible tech boom happening
Yeah.
in San Francisco right now. We already know there's a huge tech boom happening in Silicon Valley with Apple and Google. So it's really that old matrix of, well, wages aren't keeping up, don't really apply to the peninsula counties. Now, in other parts of the Bay Area and the outlying kind of the so-called bedroom suburbs,
Right.
the further you get away from the core Bay Area, those are not immune to those price fluctuations. And so so really when you talk about California real estate or even Bay Area real estate, you almost have to talk about the specific market and say, well, what's the exposure in Oakland or East
Right,
Contra Costa County or Sacramento? You really can't generalize any particular market. You almost have to be very specific into the neighborhoods.
Well, I agree with that, and I also want to add that one of the things that happened the last time, for those that are trying to circle the wagons around it being a bubble again, one of the things that happened that accommodated exactly the dynamic you talked about, where wages were not keeping track or keeping pace with home prices, was the investment world was creating more and more loan product to accommodate that. So higher loan to value, interest-only payments, very low documentation. So it was allowing those who could not otherwise get in by organic wage growth to find a loan product to finance their new home that was an unsustainable product. You don't have that this time. This time around, you've got fully documented loans. You've got very high credit quality borrowers almost across the board. Here at RPM, that's almost all I see. Though certainly those are not the only clients we can help, but you see good loan to values. I mean, it's very hard to get into a contract right now in San Francisco or Marin where you have less than a 10% down payment. Your seller is going to see other offers that could be 50% or all cash.
And you pointed out, made a good point that here we are almost a year into this new qualified mortgage
Right.
regulation that's made it even harder.
Even
It was
great
already
point.
harder a year ago
Yeah.
at this time in anticipation of those regulations to get a bank loan. So for the past year, rates are actually higher, yet prices have gone up as well. And so really, the whole argument for we're in a bubble and prices, by definition will pull back. Well, no, there really is no definition. And I don't want to get off on a, we're in a new. Remember before the internet bubble popped in 2000, they were saying, well, it's a new economy, and the old metrics don't matter. Metrics do matter, but the metrics that traditionally have been used to gauge whether or not we're at peak pricing, again, really don't apply for certain segments of the market because of the tremendous amount of wealth.
I just have one word for all of this. Gentrification. I don't know what it means, but it just sounds like a fancy word to use. Whether it's true or not, I don't know.
It is true. It is true. I tell you, you just stroll through San Francisco now, in neighborhoods you wouldn't even dare drive through in the middle of the day, let alone walk at night, are now full of tech and young
Well, that's what
families
used to
as
be
they've been
South of Market.
gentrified.
Yes,
Yeah,
exactly.
Years ago, it used
Exactly.
to be that.
because we're making loans to borrowers, all
I bet
year
you see
long
that,
that
yeah.
have been gentrifying, helping to gentrify those neighborhoods.
Because you got to start
for
somewhere.
better or worse.
Yeah.
For better.
For better, I hope.
Okay, guys, we're going to cut to our first commercial break. Before we do, though, let's see. Actually, here it is. Okay, so we have a special promotion. It's for the Cliff Hotel, all right, in San Francisco. Located just steps away from Union Square and close to Fisherman's Wharf, the Cliff Hotel in San Francisco combines old-world elegance and contemporary energy while maintaining its essence as a boutique luxury hotel. From November 7th through January 10th, Cliff Hotel is having a special. Rates from just $199 includes 2 ice skating tickets, 25% off dinner in the Velvet Room, 2 cocktails, and 2 kids' drinks. Not bad. Combine romance with a sense of family. You're sure to enjoy your stay at the Cliff Hotel in San Francisco. Call 415-775-4700 or go to clifthotel.com. Now, here is the special trivia contest.
Okay.
First of all, here's the rules.
Jimmy
okay?
Carter.
Jimmy Carter. No. You're the Jimmy Carter.
Presidency.
It
was a catastrophe.
No,
right?
as
Oh,
Mark
sorry.
always says, I always vote for Taft. That's an old joke somewhere. Okay, so first of all, here's the rules. No previous winners on the Best of Investing any of our contests.
Okay.
You've got to be a new winner. Email the answer to edward@bestofinvesting.com by midnight tonight. Next week, we will gather all the correct answers and randomly choose the winner and announce it the following week.
Got
So
it.
here's the question for that.
Okay.
10 years ago, there were less than 20 of this business in the U.S. Today, there are over 8,000. What business? Okay, that's the question.
10 years ago from today.
10 years ago.
Okay, it's 2004.
Yeah. Whenever you say 10 years ago, you mean
Well, we were
from
talking
today.
about the 70s, right?
That's okay. Hold on. No, no,
Oh, okay.
This,
All right,
this
got it.
question is for the Cliff Hotel. It's a special trivia contest question. All right. That the winner is going to
Don't
receive
confuse
Cliff
the
Hotel.
host.
Sorry.
Yeah. No. Okay. So all right. Okay. So
Screw the listeners.
that question about 10 years ago,
Got
there
it.
were less than 20 of this business,
Okay.
and in the U.S. today there are over 8,000. What business?
Okay.
That's the Cliff Hotel special trivia contest question.
Got it.
All right. Now. And so next, go ahead and email Edward at bestofinvesting.com the answer to that question. Okay, now here is the regular Lighthouse question. All right, and the theme is U.S. historical tragedies in the 1970s. All right, on which college campus were 4 students killed during anti-war demonstrations on May 4th, 1970? Now the first 3 callers with the correct answer to that question are going to win a free 3-day, 2-night stay at the Lighthouse Resort. Call 888-912-1190. That's 888-912-1190 to answer this question. On which college campus were 4 students killed during anti-war demonstrations on May 4th, 1970? And again, the first 3 callers with the answer to that question are going to win a free 3-day, 2-night stay at the Lighthouse Resort. Make sure that you spell out your email slowly. And don't touch that dial because the best of investing will be right back. The reason I have to do that because one time somebody answered the question to that type of question and thought that they won the special trivia contest. And I had to kind of go, no, listen, and I had to like, literally 3 times go, and I had to pinpoint exactly what it was so that I didn't get all
Because
like,
they get really pissed,
they get
right?
pissed, yeah, if they think they're going to win a
So
car.
So it's solar, right? And Kent.
You
All right.
get me confused.
So-
Don't answer the regular special one
Solar and
because that we have to answer next week.
Oh, okay. Turn it off. Yeah, no, I'm not going to answer that on air, but I'm asking.
Is it
Solar
solar
companies?
solar companies or is
You're
it?
gonna have to just wait till
Oh,
next
okay.
week.
It's not telling.
I'm not telling. I ain't telling nobody.
It's a
Not-
live mic.
nothing, I'll tell ya.
Was the other one Superman? Clark Kent?
Kent, that's right.
Okay.
I think that's right, right?
Yeah, Kent University.
that's my guess.
That is correct. Okay, so this one is October 25.
I can't give you the answer.
Okay. Who's on first?
Did you see that picture of the baseball player with the last name Who? Somebody posted it on
Oh,
Facebook.
that's right. And that was years ago.
Yeah,
Yeah.
someone said, "Well, finally we have the
Yeah,
answer."
and he did play first.
Did he really?
He did, yeah.
Who's on first?
Who's on first? For the Dodgers.
Yeah, it looked like a Dodger uniform.
That was funny. I like that. Okay. You ready? Oop. Yeah, write this down.
I can continue.
Okay. All right. Welcome back to the Best of Investing. I'm Edward Brown, your host, along with Mark Hoff of Pacific Private Money and Rob Spinoza of RPM Mortgage. When we cut to the first commercial break, we asked this trivia question. On which college campus were 4 students killed during an anti-war demonstration May 4th, 1970? And the first 3 callers with the correct answer to that question are going to win a free 3-day, 2-night stay at the Lighthouse Resort. Rob, what's the answer?
I can't give it to you.
You can't give it to me? Is that a who's on first, what's on second? Let's try this again.
Mark might know it.
Kent University.
Oh yeah, not Kent Clark. Kent,
What is Kent? Who is
Clark
Kent?
Kent. Okay, that is correct. Kent State. Kent State.
Fordette in Ohio, right?
Okay, so when we before we get to the break, Mark, you were talking about some interesting.
Well, we were just talking about real estate and the surprising strength of the real estate market in the Bay Area and certainly in the coastal counties of the Bay Area. But I did see also a recent graph, which obviously I can't show the radio audience, but it's basically a graph of national housing statistics, sales of existing homes over the past 10 years. And so if you look at it graphically, we've pretty much had a steady rise in the sales of existing homes since the bottom, which according to this graph was right around 2010.
Yeah.
So I know we on this show we talk about really how national housing statistics don't really play a key role in Bay Area real estate, but they do play a key role in the economy because,
Certainly.
as we know, the stock market is always impacted by expectations and confidence of the consumer, and so these types of statistics of steady housing sales and sales of new homes and existing homes, those are an important and integral part of the economy and consumer confidence. So we've continued to see that increase, and of course we've seen how that news when it comes out has impacted the stock market. Now we know, of course, the stock market has been like just crazy lately. It goes up, it goes down, it goes up, it goes down. But the
Massive
real
interest rates.
Don't do that. You're making me dizzy.
well, and speaking of interest rates,
Yeah.
I mean, we thought that the refi boom, Rob, was pretty much done after last year's low of the rates in the
Yeah.
threes, and what's happened in the past week.
Well, in the last week, we had some, we had some economic reports that kind of, what I think put the Feds back against the wall. Because remember, what the Fed's done here is they basically unwound QE, quantitative easing, which has been the program, the bond buying program that has supported lower interest rates, and that led to all of those, perpetual decreases that we saw over the 2009, 10, 11, 12, 13. So now the Fed's ending that program, but what happens next? And investors don't know the answer to that question. And when they get spooked and money flows back into the U.S. bond market, rates tend to get better. When you have employment reports, it's going to be interesting to see now, early November, what happens with October's numbers. But there isn't a lot of room for the Fed to maneuver at this point. So if the investors get wind that the economy is not on as firm a footing as they may believe, you could very well see rates dip down again. And that's what we saw last week. We saw some numbers come in that did not meet expectations, and there was a flight into both mortgage-backed securities and to Treasury bonds. And rates got, for one day anyway, they got quite a bit lower.
So bad news was good news. And in fact, I see a quote here from a woman who works for an agent who worked for Guaranteed Rate, who on that same Wednesday, when rates dipped down to 3.63% for a 30-year fixed, she sent out an email blast to 1,600 clients, and apparently within an hour got 30 responses for a refi.
I believe it.
So
Yeah.
there's just we don't know what we don't know, and we certainly can't predict the future. And to say that that the refi boom is over, or we'll never see rates as low as we've seen them previously, we're kind of rewriting all the economic rules here.
If you had a mortgage that had, let's say, a 7-year fixed.
Mhm.
Now, 7 years ago, I'm trying to remember what rates were.
Well, 7 years would have been 2007, so they were probably about 0.5% higher than they are right now.
That's all?
Yeah. I mean,
Are you sure about that?
in 2007,
Yeah.
No, 2007 would have been higher than that. You're right.
Higher,
Yeah,
yeah.
you're right.
So
I'm
I could
thinking
see
2010.
Yeah.
Yeah.
Oh, yeah. No, 2010 I could see, but so.
2007 mid fives.
Yeah, that's what I thought.
Yeah.
Yeah. So you could easily, get a refinance
Well,
situation there.
Yeah, and one of the reasons why you get a response off of those things, because certainly those of us in the industry experienced that last week, one of the reasons why you're getting a response, and I think this is a good notice for listeners in general, is that now, unlike 2010, 11, 12, possibly 13, now you may have the equity to do something with your refinance.
Yeah.
So if you were shut out in 2007, you're stuck at 5 5/8, for example. You want to refinance, you've been trying to refinance, you haven't been able to. Now your home may have the value to enable you to do that and get into something at a lower rate. So,
Good point.
there are new buyers or new borrowers coming into the fold because of that. And I think, like Mark said, we don't know where rates are going to go. They could go lower again as we go into the end of the year. Nobody knows that, but what you do know is an idea of where rates are now, and you know sort of an idea of where your value is. And if something makes sense, I think it serves you well to look into it further.
Well, and so we're in the fourth quarter, and one of the
Hard to
things and one of the things that's been
Yeah.
happening is now we're going on a full year of these new qualified mortgage rates, and we saw what the impact had on bank loan approvals, and meaning they've gone way down. But recently, there's been some news, including RPM's been in the news. You guys have introduced a couple of new loan products
Right.
that combination of easier to qualify for, and maybe lower FICO scores. I know that the
Yeah.
and Wells have been talking about that. What's the RPM? What's the news there?
Well, generally, what we're trying to do is provide access to financing for those who have been shut out because their income does not fit into the qualified mortgage box. So if you're self-employed, for example, and you have a history of being self-employed, but you don't have a good earnings history that extends 2 years deep, maybe it's only 1 year deep, 12 you were still struggling with the economy, but 13 you did a lot better, we would be able to look at a scenario like that, whereas before we would not have been able to. We also have some programs on the jumbo side that will allow debt ratios to go higher than the allowable 43%. And so these are the ways where we have programs that specifically accommodate retired borrowers and those that have a lot of equity in their house, but just don't fit in the narrow box that QM has outlined for most jumbo scenarios. And also, when I say jumbo, a lot of these programs will go down even lower than 250K in loan size. So they're accommodating a lot more people, and it's our intent to try and get some of those back into the mix.
Is there a big difference between, like, conforming is what, 417?
Traditional conforming is 417,000 and less.
Okay.
Yes.
And is there a big rate difference between the two jumbo, above?
Yeah, so what you're talking about is conforming jumbo, which
Yeah.
here in Marin County, a lot of the Bay Area, would be 625,500, and 417. So loans between those two, all things equal, will be about 0.25% different.
And
Sometimes an eighth.
What about above the 625?
And above that, then you're in traditional jumbo.
Yeah.
But what's ironic is
And
that
what's the rate difference?
those rates are actually lower in many cases than both conforming and jumbo. And the reason,
And that's new.
well, that's new, but part of the reason for that is those investors can be highly selective, okay, and they can also have a more stringent qualifying set of criteria. If you're conforming, by definition, you are Fannie Mae and Freddie Mac backed, okay, so that means that the federal, the government-sponsored entities are going to ultimately touch your loan in some fashion. So all of the guidelines that go along with that apply to those loans, but not true once you go above 625.5. So those lenders can make their own rules. They can be more selective, both on a FICO basis, both on an asset basis.
And it's all risk adjusted.
It's all risk adjusted. So they're saying, hey, look, if you've got $1 million loan, but it's a $2 million house, I can make this guy a 30-year fixed at 3 3/4, whereas a conforming loan's at 4 1/4.
Okay.
Why not?
Tell you what, we're going to cut to another commercial break, and when we come back, we get a couple of interesting emails. One for Rob that says, I have enough money for my down payment and closing costs, and my lender is still telling me I don't qualify for my loan. What gives?
Oh, we'll get into
We'll
that.
get into that
ties right into what we were just talking
That's
about.
right. And for Mark, the question he's going to answer is, I've heard you say that your interests are aligned with the fund. Can you expand on that? We'll have to understand what that question
That's an
is.
interesting question.
They're very cryptic. Okay, I think Mark probably will understand what that question is.
I do.
Okay, so here's the trivia theme is U.S. historical tragedies in the 1970s, a very uplifting trivia contest this week. Okay, on November 19, 1978, what religious cult leader led 900 of his members in a mass suicide? The first three callers with the correct answer won a free 3-day, 2-night stay at the Lighthouse Resort. I guess he didn't want to be cult leader anymore because that's a whole bunch of people. Call 888-912-1190. That's 888-912-1190 to answer this question. What, in 1978, November 19th, what religious cult leader led 900 of his members in a mass suicide? Stay with us. The Best of Investing will be right back.
They drank the Kool-Aid, right?
Don't drink the Kool-Aid. Actually, I guess
Jim
that's where the phrase
I
comes
met
from.
Jim Jones' son.
You know who I met? I met one of the guys that was in the Waco compound.
Oh, really?
Yeah, he was pretty weird. David Thibodeau was his name. He was a friend of a friend.
I know a Thibodeau family, but in Novato.
No, he lived. Well, he was when I met him. I was living in LA, but I don't know where he was from.
From your chiropractor?
He was pretty. Yeah, from my BNI group.
Does that work for you?
Yeah, it does. But I work hard at it. Yeah.
Yeah, I was gonna say, because that's one of those expensive.
It's about
things to-
all told, it's about $100 a month.
I mean, what do you get for that besides just, what you could get for just?
Yeah,
You know what I
it's a long story. I'll tell you.
Okay.
Yeah.
Because I know that you have to. It's like they almost like make you refer people to.
No, it's not that. It depends on
You're
the group.
expected to.
You were
expected to.
Yeah, you're expected to.
There's
Yeah, and it's like, what happens if you get a bunch of yahoos in there?
That's the thing.
I don't want to do this. I don't want to refer to this roofer. Or whatever,
That's right.
You know?
That's exactly what it is. Yeah, you have to be very careful.
All right. I'll be ready. Mr. Claymo, are
Is
we
that
ready?
the same Jimmy Jones that was a coach for Dallas?
That's Jerry Jones.
Yeah.
Yeah, he was
the
the
owner,
owner.
Jerry.
Oh, that's right. Jimmy
Johnson.
Jimmy
Oh,
Johnson.
Johnson. Take
Yeah,
it.
because Jimmy Jones said that makes
Yeah,
sense. Okay, here we go. Welcome back to the Best of Investing. I'm Edward Brown, your host, along with Mark Hoff and Rob Spinoza. Here's the second trivia question, commercial on a break trivia question. On November 19th, 1978, what religious cult leader led 900 of his members in a mass suicide?
You really did pick some uplifting questions,
Yes,
didn't
I did.
you? That was Jim Jones for that very unfortunate.
What was the name of the group?
Oh, that's a good one.
People's Temple.
That's right.
Okay. Okay, so now we go from that depressing thing to a little bit more uplifting
There
stuff.
you go.
Rob, question for you.
Sure.
From a listener. It says, I have enough money for my down payment and closing costs, and my lender is still telling me I don't qualify for my loan. What gives?
Yeah, what gives is these are what we call reserves in the industry. Reserves are months of your housing payment. So let's say you've got a total $3,000 a month housing payment, principal, interest, taxes, insurance, and maybe HOA fees. And that lender may require you to have 6 months of reserves in your account post-closing. So after you make your down payment, after you pay your closing costs, they want to see $18K in your bank account. And what they'll use for reserves are anything that's liquid, of course, same stuff you could use for your down payment. And they'll typically give you 60% of any IRA balance that is vested that you have access to. Okay?
And you don't have to be over 59 and a half for that
You
purpose?
need to document that you can do a hardship withdrawal. Okay, so if to stave off foreclosure or something like that, doesn't take into consideration. I mean,
Is that like, if you are facing foreclosure and take money out of your IRA,
right?
can you get away from the IRS penalty?
I don't believe so.
I didn't think so either.
Yeah,
So
I don't believe so. But
what's the hardship? I mean, you can always take money out of your IRA
Yeah,
and pay a penalty.
right, exactly. But they want to document it because there are some retirement or pension programs that don't let you do that.
Okay, not an IRA.
Not an IRA,
But,
right.
Okay, like
But-
a profit sharing.
But that's what I'm saying.
401k or something
Retirement
like that.
vested. Yeah, exactly. So you have to be able to document that you have access to the funds. Like you said, an IRA you can do it. 401k you can probably take a loan against it if you had to, whatever
Yeah.
it may be. But that's what you need to have in your account post close. Now, where it'll get trickier is sometimes you see this happen. You've got someone buying a house, but their existing house has not sold yet.
Yep.
That's known as a departure property. They're departing that property. Typically, your jumbo lenders will want you to have reserves for that housing payment as well. So you've got to make sure that your lender is covering that base, and you've got to make sure you've got adequate assets to do that.
I always thought that if the IRA was fairly liquid, let's just say it's in a mutual fund,
Right.
that if the bank were to consider taxes and the penalty that you'd have to pay, the rest would be free and clear to use whatever you want.
Right.
And
And
do
that's
they-
why they're giving you 60% of any vested balance.
Okay, so
Yeah.
there you
Yeah,
go.
so they're
That's
not gonna
actually
say-
being smart.
Right. Right.
Now,
exactly.
what if it's an illiquid investment?
Yeah, then you're not going to be able to use it as reserves.
So the bank is
Right.
smart enough to know what's liquid and what's not liquid.
Well, I mean, they're going to do their due diligence on that, and they're going to ask for statements. So when you're talking about assets, that's why the caller's question is a good one. It's like, hey, I've got my down payment, I've documented that,
Yeah.
I've got enough for my closing costs, or maybe I'm getting a credit from the seller, but they're still giving me grief about my assets. That's why, because they want to know that post closing you've got enough in your accounts to make it all go. And those guidelines are highly lender specific. There isn't a general rule of thumb that Typically, what we see is if the loan amount is less than $1 million, it's 6 months to 9 months. As it goes above $1 million, it tends to be about 12 months. And as the scenario gets a little bit more risky, rental properties, departure properties, things like that, they may have reserves up.
Yeah, I'll bet some of these borrowers tell their lenders, "Hey, stay off my ass." That's okay.
They
All
do,
right.
and they do it both ways. Yeah.
Okay, so you're a wealth of knowledge when it comes to
Well, thank you.
home mortgages, and I'm sure the audience would love to get a hold of you with questions.
Yeah, so my bio is on bestofinvesting.com. All my contact information is there. It's probably the easiest way. I work out of the Mill Valley office of RPM Mortgage. We're just north of the Golden Gate, 415-367-5959. Rob Spinoza is my name.
Very good.
How about that?
Mark, we have a question for you. It says, I have heard you say that your interests are aligned with the fund. Can you expand on that? This is obviously a long-term listener.
It's a partial question, so what that person.
But don't give us a partial answer. Give us a full answer.
So the question, I've made the statement several times that with regard to the mortgage pool fund in Pacific Private Money, we have a fund that's currently paying out 8% to our investors, and It's a mortgage pool fund called the Pacific Private Money Fund, and it is it's a it's called a private placement memorandum in the industry, but essentially it's an investment opportunity for those who are seeking high yields. And I've spoken about it, for the last year, thanks to a new regulation that came out in 2013 that actually allows us to now generally advertise these types of investments. These types of investments have actually been around for decades. In fact, all hedge funds are set up the same way as the Pacific Private Money Fund. They use the same type of legal basis for forming that particular investment entity. But prior to the Jobs Act, which was passed in 2012 and finally enacted in the fall of 2013, you were not allowed to generally advertise these, which is why most people have never heard of these mortgage pool fund investments, because unless you had an ongoing business relationship with the sponsor of that investment opportunity, they were not allowed to legally advertise it on the radio or via newspaper. And so most people are just not familiar with mortgage pool funds.
And it's not that esoteric. It's not so way out there.
It's a very simple.
It's like a mutual fund of mortgage.
Right, exactly. I mean, that's the way to think about it. It's a mutual fund of mortgage secured notes that we at Pacific Private Money generate. Most of those notes are paying. The borrower is paying about 10%, and the payout, the yield to the shareholders of the fund is right now in the low 8% range. So what the caller was asking is, you made the statement about alignment of interests between the fund manager and the fund itself. And so Pacific Private Money is a broker of privately financed loans to the real estate community and to consumers. We're a form of alternative banking. We're a non-bank source of financing. We started out by making loans to real estate investors who are buying, fixing, and flipping, and now we're making loans to consumers as well who need a plan B in order to buy that house that they want to buy. When the bank turns them down, or they don't have enough time, they need to close quickly, or they don't want to sell their existing home.
Or property's not in condition.
Right, the property's not in condition. So there's a lot of reasons why someone might go to a hard money or private money lender to obtain a loan. And so when we say the interests are aligned between the fund manager and the fund itself, that's a very, very important concept. And we're aligned because we share at Pacific Private Money, we the broker, we share our origination fees, also called points, that we charge the borrower with the fund. They're split 50-50. In addition to that, 100% of the note rate is paid to the funds. There's no servicing fee charged by the broker to the fund. And I know that seems a little out there and esoteric, maybe a little bit challenging to understand, but if you think of it that the brokerage, Pacific Private Money, who's a loan broker, licensed loan broker, we originate the loans. The fund is a separate entity, it's a lender, and you want to have an alignment of interests. And in many cases, the fund managers keep all of the origination points, and the interest rate for the note goes into the fund. The problem with that is that it can be tempting for the fund manager then to manipulate the points, maybe increase the points in exchange for decreasing the note rate. Because now he's going to be able to put more short-term money in his pocket. So in our case, we designed it to basically take care of that argument. So basically, loans that we fund in Pacific are there's an alignment of interests. Half the origination points go to the fund. 100% of the note rate goes to the fund. We don't use leverage to create our 8% yield. It's a pure yield based on the loan rates we charge the borrower minus the administrative costs and the management fee, and we're paying rates in the low 8%, which is a fabulous rate if you compare that to just about any other option out there available to you today, short of the stock market, if you are a good market timer.
Yeah. Well, I just saw.
If you're not, you're in big trouble.
Ask people last week.
Yeah. There was a bank advertising 1.5% if you lock it up for 6 years.
Right.
And Mark could get that in a little over a year.
Right.
I got to give him a little kudos here because we just found out that there's another company that invests in funds, and these guys put these fund managers through the ringer. And Mark just found out that they want to invest with him. So
Nice.
Right, so we've
that's a
just,
nice little
right, we've
flop.
just been approved for what would be akin to basically a manager of fund managers. So they have a fund of funds, and they're looking for fund managers throughout the country that they think have the shareholder alignment of interests, and they've committed to making
Gravitas.
they've committed to making some money. So for more information about how you can take advantage of the Pacific Private Money Fund, get more information to see if you qualify, please give us a call, 415-883-2150. That's Pacific Private Money, 415-883-2150. Or you can go visit the website for the fund. It is pacificmoneyfund.com.
You can always go to the Best of Investing and click on Mark there too. Okay, we're when we come back too, I want to hear a deal of the week. I know you're working on some exciting stories here, audience. You're not gonna believe some of the loans that Mark.
I saw that one email. That was pretty cool.
Yeah.
From the city. Yeah.
Yeah, it's pretty amazing. Okay, here's our third final commercial break trivia question. Again, the theme is U.S. historical tragedies in the 1970s. Excuse me. What U.S. governor from a southern state was shot and paralyzed while campaigning for president in 1972? The first three callers with the correct answer to that question are going to win a free 3-day, 2-night stay at the Lighthouse Resort. Call 888-912-1190. That's 888-912-1190 to answer this question. What governor from a southern state was shot and paralyzed while campaigning for president in 1972?
It's not Larry Flint, right?
No, and it's not Taft either, as Mark would say. All right, stay tuned because when we come back, Mark's going to get into the deal of the week, and then we'll have some closing comments. You are listening to The Best of Investing.
McGovern?
Geo Wallace.
Ah.
McGovern should have been shot.
Yeah.
Hey, let me get that on tape.
Oh,
yeah.
Oh no, we don't want that.
No, we don't.
So do you in the
Yeah,
fund?
really.
Do you have any of the short-term stuff like the bridge loans and stuff like that?
Oh,
Yeah, absolutely. I love the shorter term
They
loans in the
smooth it out.
fund. Well, they help. We can
Deal,
cycle that
baby.
money through more than one time per year, so then it really the combination of the points and the yield really
See what you
juice
made me
up the
do?
yield.
See what you made me do.
So yeah, so I like to when I have the money in the fund, when a bridge loan opportunity comes, I will always because most bridge loans are they're usually great stories, great situations.
Yeah.
You know, great borrower, usually got plenty of
Which, by the way,
Equity.
that lady, the referral, the lady,
yeah.
it's not gonna work out. She's a very nice lady, but I'm gonna get her to give some referrals though herself. She's a real estate agent. She only needed like 20 grand, and she got a first and a second. So yeah, it wasn't gonna work out.
Yeah, there are
But she was
companies like
very
that out there.
nice.
She needs to go to
Payday loan.
or Prosper.com or there's all those internet-based funding resources that.
Yeah, I would imagine those bridge scenarios would be pretty interesting because it's like you've got the light at the end of the tunnel, so that's
Yeah.
gonna make for any,
We got 8 minutes and 6 seconds. Yep. Put us at. All right. Ready? Yep. There we go. Welcome back to the Best of Investing. Last time for this show, I am Edward Brown, your host, along with Mark Hunt and Rob Spinoza. I Here's the third final trivia question, and then we'll get out of this depressing stuff. What U.S. governor from a southern state was shot and paralyzed while campaigning for president in 1972?
That would be George Wallace.
That would be George Wallace.
Poor guy.
Okay, so Mark, tell us some interesting loans. Tell us what you're working on.
Well, you teased the audience saying we'll talk about the deal of the week, and then Rob said, "Oh yeah, I got that email from you," which actually wasn't the one I was going to talk about, but
But get on the list.
But the
Yeah,
email
exactly.
really that was a great deal. It was we put out a just funded to our clientele via email last week, and because the story was so good, we'd actually done the loan last year, but the scenario was that, and this was done by our rock star top loan agent Kevin Green out of our Nevada office, and so he had a client that needed to borrow $2 million to help him buy a $4 million property in Presidio Heights.
Okay.
Well, that property, he put an additional $2 million in improving it, and it was noteworthy in that it is among the most expensive flips that were performed and resold in 2014. He sold it, the borrower resold the property this summer for $9.5
Amazing.
It's a
million
cool
dollars.
$9.5 million.
Right, and as it turns out, we estimate that this particular rehabber slash flipper walked away with a cool $2 million profit.
Now, what was the timeline on that? Just
About a year,
Okay.
and I will tell you that is not an easy trick
Yeah,
to pull off.
yeah.
I mean, we know of a lot of borrower clients and ours as well as others that have struggled in this tighter market. And the reason they've struggled is because you can't buy them as good as you were
Yeah.
able to buy
A little more competition.
distressed properties. There's a lot more competition now, but they and oftentimes, and I don't remember exactly back last summer, I believe this was an off-market transaction. Typically, the most profitable flips done today in 2014 are off-market transactions. Off-market meaning it's a pocket listing.
Yeah.
It never made it on the MLS.
Right.
It was somebody they knew or they discovered were in distress, maybe pre-foreclosure. There's a lot of ways that savvy real estate investors and flippers can find and
Let me get the
identify.
specifics on here.
opportunities.
So you lent $2 million as a first mortgage.
Yes,
And so
on a $4.3 million purchase. So he came in actually with a lot of cash.
Yeah.
This was unusual. It was a bigger loan than we typically do.
Yeah.
We actually gave this particular lender a very good rate. It was less than 10% for the no rate on this one. And he put in an additional $2 million of his own cash.
yeah, so two plus 4 plus another 2 is 6, and then
So
he
$9.5 million sale minus closing costs. And then
So
holding costs.
so by the time that it was sold, you were only at about 20 or less than 30% loan to value.
Yeah.
Well, and that's not unusual for the loans we make when we make it to someone who's going to improve the property. So oftentimes we'll make a loan to someone who we will loan, say, 70% of the acquisition price. They will come in with 30% down, and we've identified that they have the capital to
Right.
do the
Do
improvements.
improvements, right,
We get a
because-
budget from them,
yeah.
and we
Exactly.
identify that capital. Then they go and improve the property, and it's not unusual for the loan to value ratio by the time they've completed those improvements to be less than 50%, sometimes significantly less than
Okay,
50%.
so it's interesting, Rob. You were mentioning before about like getting on the email list.
Right.
If the audience wanted to get on an email list, maybe they're a little bit hesitant to call right away. Can they get on your email?
Oh
list?
yeah, you just go to our website and there's a little sign up form. It basically says subscribe to our newsletter, and it's just your name. It could be just your first name and your email address, and
And that's PacificPrivateMoneyFund.com.
PacificPrivateMoney.com.
PacificPrivateMoney.com.
You can subscribe to our newsletter. Another interesting loan this week that we just funded was again an example of loans that a lot of other hard money and private money loan brokers are not doing. And for example, seconds, a lot of companies won't do seconds. They just flat out nope, we
Oh,
only
too
do
risky.
first.
Oh,
right?
it's already risky.
And but here's an example. It was a 5-unit apartment owned by a family, and we were able to get a valuation of approximately $2 million on this. It's throwing off $20,000 a month in rents. That's not rent. That's actually the gross rents.
Right.
They're collecting $20,000 a month. Well, they have a $500,000 first position loan, and the loan payments are $3,000 a month. So $20,000 in monthly rents.
All right.
The
Well,
loan payment on the first is $3,000 a month. They needed a loan of $300,000 to improve another property they owned that they're going to sell and then repay the loan, the money they borrow from us. Well, the loan to value, the combined loan to value, you take the
That's what I was going to
500,000
ask.
the
What's
first,
the CLTV?
the
Right.
300,000 the second, that's $800,000. If we assume that the $2 million is approximately correct, and we believe that to be so, we're below 50% in combined loan to value. Now, a lot of companies would say, sorry, I can't lend you that second, but we make loans like that on a regular basis. And here's what's even better about it. The borrower agreed to pay 12%
Right, so
interest
you're
on the
much
note
higher.
because it's a second and because most lenders that they went to said no before they got to us. So
And the thing is, 300 behind 500 is okay. I don't think 30 behind 770 is a smart move, but
right, there's a ratio. We usually like to stick within a 5-to-1 ratio, meaning if it's a $500,000 loan, we won't go below $100,000. Or sometimes they'll have $1 million loan and say, well, I just need $100,000. It's like, well, that's a scary ratio. I don't know many borrowers or lenders that would want to go with a small loan behind a big loan. They call that, we don't like to put a guppy behind a whale.
Yeah.
Say in the
well, and
business.
also the interest rate on the first is really good.
It's super, super low. And again, for an incredibly well-protected loan, you can command as an investor a much higher interest rate. So this one we happen to put in the fund. So we didn't offer this out to our investor pool at 12% because that was just too good to pass up. So
And again, the
we put
fund
that-
has first crack
so,
at it.
So we put that in the Pacific Private Money Fund because we had the liquidity to do so, and so that'll help boost the yield up a little bit in the coming months for the fund. And it's all good, as they say.
It's all good. That's why it's so funny. People go, oh, these hard money loans, too risky, too risky. It's like, wait a minute, you know what? Step back.
Take a look at it.
Yeah, take
Yeah.
a look at it. Make sure that makes sense. Like something like that makes sense. And that other one, the first mortgage, $2 million, and you charged him, you said under 10%, but still 9-point-something% and a couple of points.
Yeah.
Yeah, but I mean, let's take one thing into consideration. While that property was being remodeled or redone, you were at great risk. I mean, so you're charging for a risk premium because potentially you could have ended up with nothing in the way of that property. I mean, not nothing.
No,
Right,
you know what I'm
we
saying?
we didn't give him the money at 5% or 6 or 7%.
Right.
We charged him 9%. He was happy to pay it because look, he didn't know in advance. No one had a really good crystal ball. He didn't know he was going to hit such a home run. Part of it was San Francisco real estate prices.
Well, come on,
continued to increase.
yeah, that market is tough.
He put $2 million down.
No,
so
I-
there's a lot of cushion.
I
in that.
get all of that, but still, if you have a property that has been, I mean, let's say he almost levels the thing where it's basically
No,
down
he
to
wouldn't
the
have.
studs.
He wouldn't have let him. Level
Right,
it.
but the callers or listeners need to be aware of that too. That these guys undergo some risk to make those loans.
Exactly. Okay,
Yeah.
guys. Here's our thoughts for the day. Thank you very much for joining me again.
Absolutely.
A lump of pure gold the size of a matchbox can be flattened into a sheet the size of a tennis court. Now you heard it's pliable, and
Wow.
all the gold ever mined could be molded into a cube 60 feet high and 60 feet wide. Now that's a lot of tennis courts. Okay.
Wow.
Isn't that amazing? Tune in next week to The Best of Investing. We're going to be giving away 9 more free vacations for answering trivia questions. Thanks for listening. On behalf of our team, I'm Edward Brown. We're wishing you the best of investing. So long.
Still a 6-story building, right?
Yes.